Evening, everyone who is listening to myself and Louise. We'll do formal introductions in a second, but hopefully we are now live across the YouTube, across
the channel.
I was about to say on the line. But we should be on YouTube and other stuff like Twitter, Facebook. Facebook is back online.
Hooray!
Who would have thought that even Facebook could have gone down at some point in the stage, and indeed on LinkedIn as well. So tonight I am on the chat box. So if you have any questions in regards to self-assessment tax returns, then Louise is your lady. I'm just your host for tonight. So I'm going to just interject whenever Louise wants me to. That's my quiet life. And I'm now producer.
I don't believe it.
I'm producer. I want to have a new role, which is producer, and I can press buttons. That is what I like. Yeah. Mr. Pressy Buttons. That's what I like.
We don't need pressy
buttons. So if you have any questions, make sure you type those questions in. I am going to go on my chat box now just to see on the chats app. So if you can hear me, just type in I can hear. That'd be fantastic, and I know that we are definitely coming across perfectly for you.
That would be wonderful. And just while Simon is getting everything set up, I am apparently self-assessment queen here at Optimize. I love self-assessments. I don't love my clients paying tax through their self-assessments. I love saving them tax through their self-assessments. We totted up how many self-assessments I've worked on in the last few years, and it's in excess of 3,000. So I've seen a lot. I'm not ever going to say I've seen everything because I most certainly have not. But what I don't know, I will find out.
What you don't know, you will find out.
I will.
Find out, like an investigator with a little spyglass.
So I'm here to help, and I'm here to help rather timely, I guess, because we are days away, just to scare everybody half to death, including myself. We are days away from the self-assessment filing deadline, if you're doing it by paper. We are just, in fact,
I was going to let you off because you're putting people into a state of fear.
I'm not. I'm here to help.
It's 31st January. It's not helping.
But that's paper. And it's less than 3 months away. If you want to file your tax return and shove your tax, in a very non-technical phrase, shove your tax into your 22-23 tax year, because you've got to get it filed by the 31st of December electronically if you want to do that. And you are less than 4 months away if you're not doing any of those things and you've got to file electronically.
Move this slightly back. Give us some dimension.
Give us that. Make me less scary. That's what you're trying to say.
Yeah.
Sorry.
So in that case, then let's get on with the show. If you've got any questions, guys, do feel free to. Don't be shy.
Gimme.
Do ask those questions. We'll get onto those questions for you. And the first question is from a regular, Max Jones.
Hello,
Give
Max.
us a shout out, Max, if you are watching us live. That'd be great. And I saw 2 people give us a thumbs up. I'm going to give us a third thumbs up. Thumbs up. Likey.
Excellent.
Yeah. You could do that on Facebook, Twitter. You could do it on YouTube. You could do it on Daily Motion. You can give us like everywhere, quite frankly, even on Google review. Just leaving that seed there for you. So Max has asked a question. Does my UK rental income need to be reported in Hong Kong?
This is the point where Simon promised, didn't he? He was just here to produce. He wasn't here. He wasn't going to make a pipsqueak of a noise.
I'll take over now.
Exactly.
Take over. Louise, over to you. I mean, let's talk about UK income.
Yes.
And whether UK income is reported if you are living in Hong Kong and not in the UK.
I'm going to hand over to my esteemed colleague to my right and to your left, Simon.
Well, no. From a UK tax perspective, if you've got UK rental income, you still have to declare it on your UK tax return.
You certainly do. So you don't escape it, sadly. Whether you're based here, based on the moon, based in Hong Kong, based somewhere else, if you have UK income, then unfortunately that UK income is going to be subject to UK tax pretty much in almost all scenarios. I won't even start talking about offshore trusts because that's a slightly different scenario. But if it's in your personal name, or it's in your limited company, or it's in, which is a UK company, that is. But more importantly, we're talking about personal tax returns. So for example, you might have a partnership or a UK trust. Yes, I'm afraid you're going to have to present that income for tax purposes to HMRC in a tax return.
And I guess in terms of just talk about any type of country that they could be residing in, the argument is if it's in the country, you're going to be taxed in the country the asset is being generating an asset, an income, I should say.
In the majority of cases, and you know this better than I because of your international tax status and knowledge, but pretty much they call it what's called the Situs Rule. So where is your asset sited? Where is it physically based? And if your asset is based, unfortunately, here in the UK, and it generates an income or a gain in such a way that it causes a UK tax, I'm afraid it really doesn't matter where you are. It matters where the asset is.
And to Max's point, let's talk about international tax for a second, because it is so important. If you are earning money in the UK and you happen to be a foreigner, whether you're living in the UK or not, doesn't matter about the country of origin or wherever you got a tax status. So give you a couple of examples, but from Max's point of view on Hong Kong, there is no income tax from the Inland Revenue Department in Hong Kong. But if you have got, let's say, Australian stuff going on, then the tax authorities there, I can't remember the name of it now, but the tax authority in Australia will require you to pay tax if you are deemed resident in Australia. So it can be quite difficult because they're not bothered if you're not resident in Australia, which is very different to America, where they just tax you on everything. No matter if you got placed in
Uncle
on
Sam
Mercury,
wants your money.
Yeah, IRS want your money even if it's on Mercury. So that's basically what you got to watch out for. So hopefully that's answered that question, Max. But let us know if you need any more,
leads to another,
or if it leads to another. Here's your friend again.
Oh, Pradipan, hi.
This time around, I'm not sure if we've answered this question, so you'll have to tell me. But Form 17 and Deed of Trust, do I need to do a second one if we sell a property? Actually, no, we haven't.
We have had this conversation. Pradipan, if you're on, great question.
Before, let's set the context. I always like to set the context with this stuff as the main producer of the show.
Next, we're going to have little waves across the screen going.
Oh, that's so 1970s, not doing that. So let's set the scene. What is a Form 17? What's a Deed of Trust?
A Form 17 is a document that HMRC require you to complete and release to them in a certain time frame to accompany some deeds of trust. And a deed of trust is a document that summarizes, normally in a personal tax return kind of property environment, a change in ownership, both beneficial and actual, in terms of incomes and ownership of an asset. So those two documents have to go together to HMRC to prove something has changed more often than not.
Okay, and did you mention about the percentage ownership, whether you need to do a deed of trust Form 17?
I wasn't getting that complicated.
I think it's worth it.
So Form 17s are required to accompany a deed of trust to HMRC. So if you want to show HMRC the documentation, which you might need to in pretty much all cases to capture that data inside a tax return, then you only need a Form 17 if you're changing the ownership from something that's already 50-50 to a different percentage ownership. So if you're changing it as an extreme from 50-50 to 99-1, or maybe not even an extreme, as mad as this sounds, from 50-50 to 51-49. Could be as small as that kind of change, but where you are moving from something that is currently 50-50 to something different because of a deed of trust, Form 17s are required. And
when does it need to be with HMRC and attached with?
Oh, now you must file your Form 17 and your deed of trust, or if you don't need a Form 17, the deed of trust, within 60 days of execution of that deed. So in other words, when you sign and date it to say it goes live from this date, you've now got a clock ticking of a maximum of 60 days to get it into HMRC. If you send it in and there's more than 60 days gone since that document was signed and dated, or from when the deed of trust was operating from, I'm afraid Hmrc will send it straight back to you and say, no thanks, do differently.
They don't even send it always back to you. They just keep it, throw it away. So the question really here, Louise, and this is a great setup for my next bite-sized video, but how does a deed of trust and Form 17 help you to reduce capital gains tax if you have already done a Form 17 to manipulate the income?
Okay, so let's talk about an example. I'm not going to name names. The client moved an asset from a 50-50.
Rupert there.
Moved it from 50-50 to 99-1 because they wanted the income to land with the lowest tax rate partner out of the couple. And then at some point in the future, they decided they were going to sell it. So what they did with our guidance is they moved it back through another deed of trust to a 50-50 ownership. Why would they do that? Well, that was to ensure that the income split across the two of them, which meant both of them could use their capital gains allowance, so the annual exempt allowance. If you're familiar with the phraseology, it's the amount of capital gain you can earn every year tax-free, which right now is £12,300, happy days. But because of some changes to tax law a couple of years ago, it also means that if one of the partners had lived in the home as their own home in the past, but the other partner had not, by doing the deed of trust, it means also that that partner who didn't live in the property suddenly inherits as though they did live in the property, and they get extra tax relief. So I helped a client to minimise their capital gains tax by doing exactly what I've just described, moving back to a 50-50. And I think we saved them about £200,000 in capital gains tax. So it's really, really something to think about very carefully, and it needs to be done before you get to exchange of contracts.
I think you can do that within the same solicitors, can't you? You can just get the same thing. I think what's really interesting about that scenario is what you've done is you've helped that client potentially, with their capital gains tax annual exemptions, because everyone gets 12,300. And in the first example, we might have said, well, one person gets 99% of the income, and the other person gets 1% of the income. Mainly high rate taxpayers, additional rate, they would have a lower form of income. But if you sold the property in that split, you wouldn't get the CGT annual allowances, which is what you're talking about. But one person may have losses as well. So you want to think about, well, where is the best use of doing a second deed of trust, even though you've done your first one, of saving CGT?
And this is the lovely thing. So Simon's just raised something we haven't even started to talk about yet, and that's capital losses. If you've made losses from a capital sale, those losses carry forward in a little bucket, in my head, in a little bucket every tax year until you put them against a gain. That means that your losses will work very hard for you in future. They may be very painful at the time. No one wants to make a loss, I appreciate. But those losses basically will help protect a future capital gain, so they're not wasted.
So moving on from that, hopefully that's answered your question there. If you are live, then make sure you do. I should be looking at you if I'm talking to you. Since we are live, do ask your questions live. Wherever you're watching, if you're on LinkedIn, on YouTube, or wherever, make sure you get your questions in tonight, because we want to support you as much as possible.
We do.
To make sure you're tax efficient as much as well as doing your tax return on time, which is a passion of Louise's.
Did I mention it's just a few days away if you're filing paper?
No, please do tell us again. Right, so Google. So I've put in some seeded questions here, guys, because I just didn't get enough.
That's what it means.
So I wanted to have a look at this. So and I will go to our Facebook Live, our LinkedIn Live questions in a second. So do bear with me. If you've asked a question, I'm going to come back to you guys in a second. But here's an interesting one: is how do I let Hmrc know that I've had property income over the last 5 years?
Ooh.
I've put a hint in the brackets there for you, because I know you love that subject.
I adore it. So by the very way that question has been phrased, it means I need to confess I haven't told anybody about my property income.
And you don't say that on air.
Well, I'm not saying it's
haven't
me.
we declared our income?
We have done it. What I mean is that you have not expressed to anybody that you've made income, and you might not even realize you've made income. And I know that sounds ridiculous, but you may still find yourself in a place where even though you're making a physical loss to do with your property business, you still have a responsibility to tell Hmrc about it. And that's completely mad, but it is just the way it is. So identifying you need to tell Hmrc probably means, particularly if you've got more than 1 year's worth of data to capture and tell them about, a let property campaign. And you can go away and Google that phraseology if you wish. Let property campaign. It's basically the UK taxpayers' methodology of fessing up that there is some property income from prior years. It's too long ago to file a tax return, most likely, and that you want to tell Hmrc about it. It is no good sticking your head in a bucket of sand and pretending that it didn't happen, because Hmrc have so many methodologies and ways of uncovering this data. It might not be today, might not be tomorrow, might not be this year,
but soon, and for the rest of your life.
Sorry. But they will find it, and then they'll come to you and they'll ask you about it. If they come to you and say, have you had property income? And at that point you confess up, I'm afraid the fines are typically twice the size as if you stick your hand up and go, excuse me, Mr. Hmrc, I think here I should have told you about my property business, and I didn't realize, or whatever the real reason is that you haven't explained it to them. Maybe you didn't realize you're making the income that they needed to know about. But whatever the reason is, it is going to be much more gentle on you if you're the one knocking on Hmrc's door to tell them about it, rather than they knocking on yours. And the let property campaign is the method you follow. There's a phone number, you call it, you explain you want to describe your property incomes. They're not judgmental, they're there to help you. They'll send you a special code. You use that code to then prepare a single form for all the years that you've missed. And then you tell Hmrc why you missed it. And you need to be very honest with them as to what's been going on. And then they will work with you to assess what the penalty is. In some cases, they can turn the penalty to 0. In some cases, the penalty can be as high as up to 200% of what your tax position is. Bear in mind, the 200% is so rare, it's ridiculous. It's almost hen's teeth. But if you've done something really naughty and you know you've done it, and then you are really obstructional in not helping Hmrc get under the skin of what's been going on, you could find yourself closer to the 200% than the 0%. Most people who we work with tend to end up with a penalty of a maximum of 10 to 20% of the tax. And don't forget, what I've just told you is that in some instances, you haven't made any income. And if you've not made income, you haven't resulted in a tax bill. So your tax bill, even at a 200% bill, is a big fat 0. So please don't be worried. Just get on top of this and deal with it.
I think it's fair to say, when people are doing their let property campaign, that some people, when they do the numbers together, they realize they don't have any tax to pay, which is a huge amount of relief. But the other side to that coin is people who are putting it off by looking at the analysis and say, well, I don't really want to raise my head because I don't want it to be shot off. There is a phrase, isn't there? Don't raise your head above the parapet, because you will get it shot off. But actually, that's not always the case, because if you do the numbers and then you realize, actually, I've got no loss. You've got losses to carry forward, which is something you want to carry forward on your tax return anyway. Doing this exercise may just lighten your load in everyday life, because it's amazing of how much mental health kind of concerns we have, stress being one of them, and the uncertainty, the unknown of, well, if Hmrc knock on your door tomorrow, you know, it's better to fess up.
I personally agree. And the clients that I help with this, and we do this a great deal for many people, more often than not, there is literally a relief once it's filed, and a relief to understand the scale of what they're dealing with. It's often significantly smaller than you have allowed yourself to blow it up in your mind's eye as to what it can be. I've had clients who have, quite frankly, hidden from the mail that arrives in a brown packet that looks like it's from Hmrc for multiple years. They've even been on medication because of the stress that this has caused, not because they've got to the bottom of it and realised the scale of the issue, but because they have done exactly the opposite. They've ignored it, they've pretended it wasn't there, it's kept them awake at night. And when we've dealt with it with them and for them, they've had a new lease of life. So don't let this sit above your head as a nasty dark cloud. Get it dealt with sooner rather than later. And it's amazing what a difference it can make. We find a lot of the time that clients are actually sat on massive losses that they've not recorded. And had they not been through the process, they wouldn't have had those losses. Back to my little bucket analogy earlier, they can now carry those losses forward and use them to protect their property profits for the next 2, 3, 4, 5 years. They won't have to pay any tax at all. Had they not done the analysis, they would never have realised they could save themselves that kind of money.
No, fair point. And I think with all of this, it's all about just working with specialists to help you go through the numbers and putting a document that is evidence-based. That's the only thing about this, is make sure whatever you put to Hmrc, you can back it up with clear evidence, receipts, completion statements, the lot. You needs to be all supported with whatever you're doing. So make sure you do that. Great question. What I am going to do, I'm going to go over to my chat box now. So good evening, Bob. Bob has asked a question. What are the tax submission implications? That's a good question, actually. We've never really covered this because we talked about tax returns being submitted. But let's talk about tax returns not being submitted on time. What happens?
Well, funny enough, there are Hmrc love their penalties. There are 3 penalties that can occur if you don't do what you should do. The first penalty is a really odd one, and we've just gone past the deadline, funny enough, at which the penalty could be missed to do with the 2021 tax year. So that penalty relates to informing Hmrc you need to do a tax return. If you're late in telling them about, for example, the 2021 tax return requirement that you have, and you didn't tell them you needed to do a 2021 tax return, then you can pick up a £100 fine for late telling, basically. And the deadline to which you have to tell Hmrc after the end of a tax year that actually you need to file a tax return for that tax year is the 5th of October. So long as you've told Hmrc I had self-employment income or I had property income in the 2021 tax year by literally, I think it was, gosh, I've forgotten what day it would have been, 8, 7, 6, 5, about Tuesday last week. So the 5th of October, then you would have been absolutely fine, and they would have sent you a confirmation that you're going to get a UTR and you'll need to file. If you tell them after that time and date, they are at liberty to fine you £100. They might not, depending upon the reason that you told them late. And you can't say it's only because you listened to my video. Sadly, that's not going to cut any mustard. The second penalty is if you then file your return late. And as we all know and love, if you're filing a paper copy, did I tell you it's the 31st of October for filing?
Yeah.
Did I? Yeah. Okay. So if you don't file a paper copy by the 31st of October, the world is not over, but you do need to file electronically, and you have to file, or the majority of people do, by the 31st of January 2022 for a tax return that ended on the 5th of April 2021. If you don't file by that timescale, and assuming Hmrc don't extend their allowances as they did only this time last year, then you've got a £100 penalty for filing late. That grows though. So if you haven't filed that tax return by the 1st of May 2022, get ready for this. You're going to pick up £10 a day penalties up until the end of July, at which point your fine for not filing on time has now grown to £1,000. And it will continue to grow, but every 3 months after that. And the amount it will grow by, we can talk on a different topic another day, but I just want to kind of bring that to life.
What about interest?
Well, I've not got there yet. Just one moment.
I'll just be able to do another show.
Moment. And the third issue you face is if you haven't paid your tax on time, which of course needs to be by the 31st of January, then you're going to pick up penalties for that. Now, the penalties are twofold for that. The first is late payment interest, as Mr. Simon here alluded to. And that goes at what's called the official rate of interest from Hmrc, which I think is about, is it 2% at the minute?
Well, isn't it normally 3% or something like that?
It's dropped down to 2.5%, I think, recently. But that's per annum. So for every £100 you file a year late, you're going to pick up the equivalent of £2.50 in interest, very broadly. If you haven't filed, and I think if my memory serves me right, it's 30 days after the filing deadline, which is the 31st of Jan. Once they know what the real tax is due, if you haven't yet filed the tax return, they're going to fine you approximately 5% of the tax not paid by that date if you still haven't paid it 30 days after the 31st of January. So there's all these different types of fines suddenly racking up and causing mayhem if you're not careful.
Mm-hmm. And equally, the amount of added cost, the stress, all of that adds up again. So it is about getting your tax return done. What's that date? I forgot.
Oh, have I not told you?
No.
31st of October if you're filing paper, 31st of January if you're filing electronically.
Right. I must remember those dates.
Here's the fun bit. That's per tax return. So if you are filing partnership returns alongside a self-assessment tax return, alongside a trust tax return, all of those fines basically are per tax return. So you're late in filing a trust, a personal and a partnership, then multiply it by 3, what I've just told you.
I think Bob's sitting there thinking, I only asked what the implications were. But Bob, hopefully that's a bit more of a thorough answer. Bob's asked a question about implications of moving from SA to LLP. I will come back to that because someone else has asked the same question, but I want to focus on as much as we can possible on tax returns and submission of tax returns tonight. And we'll try and get that on we've got a business and property tax session next week.
We have.
So we can always answer that there. And hopefully, Bob, if you can be on that'd be good. It says here, here's a tangential question, because we talked about self-assessment tax returns, but as SS has asked a question.
Hi, SS.
I'm just trying to work out the picture, what that is. Not sure. SS, you're going to have to tell me.
Glasses.
In fact, they are glasses, but I'm not sure. They're not helping me. That's for sure. SS has said, hey guys, when would I have to do my tax return if I registered my company at the beginning of the year? Which is really interesting, because we need Emma Pincott here really for that one. So what Louise has been describing to you tonight so far is personal, as an individual, self-assessment tax returns that you send to Hmrc. But with limited company accounts, and this wonderful example is just keeping it nice and simple, if you've got a year which starts from the 1st of January to the 31st of December, you have to still do your tax return. And your tax return, you've got 2 sets of documents that you need to file. You've got one set of documents that needs to be sent to a company's house, and it's 9 months and a day after your year end. So in that case, we're talking about the 1st of October. You're looking at me very strangely. If I said something wrong here.
Keep going.
Right.
I'll mark you in a minute.
And the other side to this is that you have to then submit a tax return to Hmrc within a year of your year end. However, I think you have to pay your tax return 9 months and a day after your year end. So why would you make your payments to tax and then later on do your tax return? It's
very about face. Slightly change, I would change. You've actually got 3 deadlines to do with it. And this is a limited company, by the way. So I'm very sorry, SS, as Simon has given you a great answer, but not to the question that you asked. So if you're filing your company accounts, it's 9 months after year end. You must pay the tax 9 months and 1 day after year end. You must file the tax return 1 year after year end. So it's very, very mad.
Wasn't that far off? I mean, 9 months.
On 1 day.
Is it? Are you marking me down for the 1 day?
It's a good job we have Emma Pincott in the team. That's all I'm saying.
The Colonel.
The Colonel. I thought she was a 5-star general now.
Yeah, she's definitely
been promoted to 5-star general. Yeah. She keeps everybody on their toes. So as a slight aside, if what you meant, SS, was that you started a business as in a self-employment business, not property, but self-employment business in your personal name, so sole trader is also a phrase that a lot of people use, then it gets a bit more complicated, because potentially you can choose to present that entire year, that entire calendar year's worth of income in the tax year at which the accounting year ends. So in that example, let's imagine 1st of Jan 2021 to 31st of December 2021. The 31st of December 2021 is the year end of that business year. That falls in the 21-22 tax year. So you would present it as your self-employment in the 21-22 tax year, even though the majority of it, or some of it, I should say, fell within the 2021 tax year. And it also means that you have to tell Hmrc about that business no later than the 5th of October 2022.
I think you and I are going to fall out live, because SS quite clearly said, when would I have to do my tax return if I registered my company? I'm not sure why you talk about self-employment tax.
Well, because registered a company, you're making such assumptions tonight. I'm so sorry, SS.
I think
for you.
there is the phrase here is bang out of order. So let's move, which is what Facebook coined the phrase last week.
Did they?
Moving on. Right. So out of order. So let's talk about Jazz Kisson. Sorry. Has said good evening. So Jazz said, good evening. I'm in the process of purchasing a property, 95 and 5, husband and wife. Do I still need to do a deed of trust to follow with a Form 17?
Great question. If you've bought the property in that 95-5 split.
Your Honour, they said, I'm in the process of buying a property. Devil's in the detail.
Oh, angels are in the detail too. So if you are buying it in that format and you've not got to alter the ownership to get to that format, then you won't need a deed of trust and you won't need a Form 17.
No, because you would buy the property in what? So there's there's two types of narrative you need to understand whenever you're buying property. There's one called joint tenants, which is what percentage?
50-50.
And then there's tenants in common, which is not
50-50.
See how it works. So the tenants in common, it can be any percentage. So in your case, you'll be just buying a property, tenants in common, which is 95 and 5. In your case, you don't need a deed of trust and Form 17. However, what's the issue of, so if you buy a property, and here's one for you all to listen very carefully.
And here we go.
Are you listening? So if you buy a property that's 50-50, what happens when you die?
Well,
or one of you dies?
Depends whether your tenant's in common or tenancy.
I said if it's 50-50.
Oh, that could still be
tenants in common. So it'll be joint tenants.
Joint tenants. So the legal rules are if one partner dies, then unless the will says something other, the asset will automatically, or the part of the asset for the deceased ownership will automatically pass to the other owner, if you like, of the asset. Not so tenants in common.
No. And tenants in common, what happens is the asset, executioner, the executor of the will, not the executioner, different connotation, they would look at the will and say, where does this asset go to? Because it's not going to naturally go over because it's not joint tenants, it's tenants in common. So therefore, I've got to look at the will now and then give it to the right person. How many times do I have a conversation with people? And do put your hands up, people. Yeah, you could do it like that. Or just, in your own mind. And I'll answer this question. Do you have a will? Question 1. Question 2. I don't know why I'm holding my hands like this. Question 2. When's the last time it's been updated? Oh. So most people will say, no, I haven't got a will. And the next group of people, which is the other 85%, will say, I haven't updated the will since my last purchase. And then the rest of the 5% that have done both of those things, you get the pats on the backs. But I rather suspect that most people have got out-of-date wills or is not valid. More so if you're foreign. So the amount of people that will say, I'm from another country or I'm going to another country, do I just need one will, which will do my worldwide legal? And the answer is no. Wherever you have assets, you need a will in that country. So there you go. Soapbox over.
For now. Sorry.
For now. Rob has asked a question.
Hi, Rob.
Is tax due to the landlords on the tenancy agreement or whose name is on the mortgage?
Ooh.
Neither. It's the truth of it. So what's Rob's asking the question is tax, so where is the income attributed which is what Rob's asking the question.
Taxable income.
Taxable income for the landlord, is it based on the tenancy agreement or on the mortgage? That's a classic, because it's neither. I've never had that way. It's neither.
I'm trying to read the question because so if what you're asking, Rob, forgive me, I'm probably reading more into this than there is. If you're asking who is responsible for any tax on any income to do with the property, it is whoever is contractually.
Yeah, just let him finish.
Sorry, Rob.
Right. So Rob's added to that to say, meaning if the buy-to-let mortgage is in joint names, but only one name is a tenancy agreement, who pays the tax? And it goes back to whoever is on the legal title. It doesn't matter really who has a mortgage, because let's be fair, you could get a property for your child to live in, but you are the personal guarantor, or you could be the only person on the mortgage. The mortgage has no bearing at all on who has got the taxable income. And indeed, the AST doesn't really make much difference to the AST necessarily, because that's not the legal record that HMRC are going to tie you down to say you should be paying tax. It's who is on the legal record. Legal record being the deed of trust, which is the documents
who
we
is
talked about,
entitled to
the
beneficiary
conveyance,
income,
and on who the person named on the land registry. So unfortunately, it's a great question, but the reason why I chuckled is because I do see that a lot.
I think I see it a lot more with clients historically who used to do what I call rent to rent. So in other words, they might borrow, for want of a better phrase, a property from a genuine owner. And they would then go and seek to make more income on it than perhaps the original landlord or owner did. But ultimately, the actual real owner of the asset would still be recompensed for their time by the rent-to-renter, if I can call them that. So the real owner would end up having a taxable income from the rent-to-renter, and the rent-to-renter would have a taxable income from letting it eventually to a live-in tenant, assuming it was a residential property in that example. So I'm afraid anybody making income from an asset, whether you're on the mortgage or not, is highly likely to end up paying tax. Back to one of the first questions we answered, which was, where is the asset cited? If it's cited in the UK and you're earning an income from it, then expect to be taxed on it. The fact that the original owner might be being taxed on a different number because you're paying them a different number to the rent you're earning is really the key point.
I do apologise for that. I thought this was on mute. The reason why I'm being is because someone's asked a question about allowable costs. So I'm going to send that over. Agni has said, any interest allowable expenses for buy-to-let company. So maybe we should answer that. Yeah, I was going to just do a quick video shout out, but actually it might be worth having a look at that. So let's think about, again, let's position this as a famous producer that I am. Beeb, if you're watching,
Spielberg, don't be frightened.
If you listen, ruining it now for me.
Sorry.
The executives were watching me on from BBC just then.
Keep going.
Switched off.
Sorry.
So sorry. Right. So Agni, we need to put this in perspective. The question from Agni was, any interesting allowable expenses for buy-to-let company? And that's an interesting phrase, because really there isn't that much difference between allowable expenses typically on a property, whether you buy it in your own personal name or indeed a limited company. And the 3 R's that you are famous for, Louise Misiewicz, are
repair, replace, renew.
And why is that so interesting? And give me some examples what a repair, replace, renew is. And this applies to whether you buy it in your own name or indeed a partnership or indeed a limited company.
So repair, replace, renew is typically a group of assets that a lot of our clients forget that they're allowed to utilise as a tax reducing expense. It's a legitimate expense you can put against your property business to help minimise your profits. And therefore your profits are what your tax is calculated on, albeit profits are slightly different these days with Section 24, and I won't bore you with that level of detail. But repair, replace, renew. Repair, replace, renew are looking at basically the assets within your building and your building itself that you have to maintain. So you could be, for example, repairing a broken window. Those costs of repairing that window in your rental property will be allowable as an example. Replace might be that you have to replace the window. It's just not fixable, or rather it's not economically viable simply to repair it. You're better to just rip it out and put a brand new one in. Renew often refers to a bigger aspect of work within a building. So you might be renewing, in particular, Simon likes to pick on things like kitchen. So you might be renewing a kitchen by stripping out an old, tired, completely worn out kitchen and putting in a replacement kitchen that allows you to then basically utilize the property as it should be. So that's generally what repair, replace, renew covers. Anything to add?
I don't think so. I think if the costs aren't going to be covered as part of the repair, replace, renew, which is 100% allowable, there is in fact, before we finish, there is a challenge on repair, replace, renew. Dilapidated properties, it won't be allowed as a cost because?
Well, because, and this is back to a very old piece of shipping case law, would you believe, that if the asset is so badly damaged that it can't be used at all, it's not safe to use potentially until it has been brought to a particular standard of repair, then I'm afraid all of those expenses, even my example of replacing a broken window as an example, all of those costs will be considered capital. And sadly, whilst capital costs will help minimise capital gains tax at a point where you might sell the asset, it's not going to help minimise your tax position in year against income tax from the rental. So consequently, if you are having to bring a building up to a standard in order for it to be livable, whether it be repair, replace, renew, I'm afraid it's all going to be classified as capital item.
However, there is a saving grace, which I like to call the 3% SDLT and the SDLT residential rates, because if it's dilapidated, you don't need to pay those rates because it'll be non-residential rates. So even though we're not giving you the answer you want, we have just given you a massive saving, which you can put there as a share thing on our YouTube channel to give us a donation. Right, there isn't generally. There isn't there. If there was, I'd be shouting about it all day. So that's that. There is something else in this though with the allowable costs. Is Hmrc would say, well, if you're spending a significant amount of money, then it was never an eligible estate, therefore you can't have the cost. But one of the terms of the buy-to-let mortgage is that the property's got to be in a
lettable, livable state.
A lettable, livable state. So Hmrc are kind of over the barrel, and they just can't get you anymore because you've got if you're a chess player, you've got all your pieces lined up, and the king of the Hmrc is falling over quite quickly. So as you might say, that's called a blunder in chess. Wow, geek. Right, moving on. We need to go to Emma Cutmore.
Hi, Emma.
Emma's a regular on this show, asking some great questions. And she says, I have fostered for a young person for 3 months in 2021. Is it correct that I do not pay tax on income up to 7,500? I was really fascinated by 7,500 because I straight away went, hold on a minute, isn't that the rental room relief scheme?
And funny enough, I'm going to come on to this in a second. Rental room might actually be applicable in some ways. But Emma, my hat off to you for helping somebody. It's wonderful what you're doing. So what I would say to you is go and have a look at Help Sheet 236 or HS 236 at Hmrc. It helps you understand what's called qualifying care reliefs. And this is what you can, I'll say earn, which is not really what it's about, but the income you're given, so to speak, by care services in order to take care of that individual will not be taxable up to a certain amount. It's a little bit sophisticated in the calculation, but broadly, if you're taking care of somebody in a foster environment, then so long as you meet certain conditions, then the first £10,000 of those care packages that you get will be tax-free to you. But you can add on top of that, and depending upon how old the child is, or if they're not a child, the adult is, then you can add a further, I think it's £200 per week for children of 11 and under, and £250 per week for children 12 and over, and adults. And it's based on a week-by-week basis. And I think, as mad as it sounds, the weeks are a Monday to a Sunday. So if you take on an individual, for example, on a Wednesday, and they leave your care by the following Wednesday, that's actually equivalent of 2 weeks, because it's run over that Monday to Sunday. So you'd get, in that instance, 250 times 2 weeks, so £500 to add to your 10,000. It's prorated as well, that 10,000. So if you only look after an individual for part of the year, you've got to work out how many nights of the year, and therefore multiply the 10,000 in effect by that same number. So if you only look after, and I think your note, Emma, said for 3 months perhaps, then you would only get in effect 1/4 of the 10,000, so 2,500 plus, if it was the full 13 weeks, the quarter of the year, then either it's 200 or £250 times 13, and you'd add those two together, and that would be the tax-free amount. If your qualifying care package is bigger than that calculation, though, you've got two ways you can deal with it in your tax return. The first is you ignore everything up to those tax-free elements I've just described, and then you are taxed on the portion that falls above those qualifying tax-free amounts, and you get no relief for any expenses you might have incurred in doing that work. The alternative is that you can basically capture all of the income in your tax return, less your expenses. So actually, you've got the opportunity to look at the calculation in two different ways to see which gives you the best tax position, and then you're allowed to use that. And that's not too dissimilar, funnily enough, to rent a room relief, which I know we talked about a few weeks ago, in that you've got two methods to calculate it. You either have the first 7,500 tax-free, and then you taxed on the remainder, or you have it all taxed, but that means you can claim all the expenses as well. So I probably haven't done a great deal of answering of your question. There are tax-free amounts, but it really, as I say, depends on what the age of the individual is that you're looking after and how long they've been in your care.
Wow. And I've put, Emma, if you're listening in, hopefully you are, but I've put a link into the video description, so you can see that link coming through as well in the chat box, actually. Some great questions coming in. I'm just going to go to just a double check. Bob and Lorraine asked a very similar question. I did say I'll come back to you, Bob, and I delivered. So Bob said, moving from self-assessment to LLP, and Lorraine Gordon has asked a question about using deed of trust, which we've described already, and then a partnership, which is what an LLP is. LLP, for anyone listening in, just means a limited liability partnership. So LLPs typically have a corporate veil, that's an American phrase, but a corporate protection because it's a legal entity. But the tax is opaque. Sorry, that's another American.
You go very American.
I go very American. Greenbacks would be very proud of me. So the kind of income would go into your personal self-assessment tax return anyway. So anything from any difference really between a partnership and just a normal standard tax return using deed of trust, really?
Yes. Partnership Act 1890 for a start starts to bring that to life. But cutting a long story short, just to cause more confusion before we start clarifying, there are 3 different types of partnership that are available here in the UK. What's referred to more often than not as a simple ordinary partnership, or P, a limited partnership, or LP, and a limited liability partnership, or LLP. Many of our clients work with partnerships, and we have a lovely smattering across all 3 of those. The common feature of every single one of those is that if you are a partner of one of those partnerships, I'm afraid that income is going to be subject to income tax, not corporation tax. So you're likely to find a higher tax rate, particularly if you're a high rate or additional rate taxpayer paying 40 or 45% on some of your income. That's exactly what's going to happen, sadly, on your partnership income as well. And in fact, your partnership requires a separate partnership tax return known as an SA 800, whether that be a P, an LP, or an LLP. And portions of what's presenting in that SA 800 are literally lifted and shifted straight into your own personal SA 100.
Lifted and shifted. Remember, you need to quote that one. Lifted and shifted.
Lifted and shifted. And very, very unhelpfully, I do find it amusing. I make a comment about this every time I do one of my screen recordings, explain to a client their tax return, because that's what we do here. The SA 800 is about the only tax return I ever get my hands on that of itself doesn't create tax. It's completely mental. It's called a tax return, in my opinion, but there we are. Hashtag Louise for president whenever we take on presidencies. But the SA 800 is a tax return in its own separate world and sphere that is specific to your partnership. I guess the critical things about whether a partnership income presentation is different to that in a personal tax return is really down to how you divide the income between you. In some instances, a partnership allows you to very comfortably toggle the amount of income each partner is receiving based on some pre-agreement, such as, well, the amount of work you're putting in or the amount of business you bring to the table. It's a bit more complex to try and achieve that with a property partnership, but that could be for another night, which makes it a little bit easier because, of course, in a partnership, you're not now a sole trader. You've got other people working with you. That's part of the definitions of a partnership, 2 or more people in business to make money. And as a consequence, you're doing this partnership return with others. So there's others' input to it too.
I think just to add to that, though, Lou, is the fact that I'm not sure if I should call you Louise for this show. Very
Ms.
professional.
Misiewicz, I personally feel.
Is that right? So Ms. Misiewicz.
Or the boss. You can call me what you like.
One of the things I was thinking about here was if you had property, and Will Martinez has asked this question, which ties nicely with what we've talked about already. If you had someone else who is not husband and wife or civil partner, but just boyfriend, girlfriend, or whatever, or friend, who wants to be involved in the business, if you want to allocate some of the property income, as in the beneficiary interest, what tax would you have to pay? 2 taxes.
Well, why don't you tell everyone?
Twin spoke. Stamp duty, land tax, capital gains tax. Okay. And if you're into Marvel, that is almost a Doctor Strange kind of wizard thing going on there.
It's more a wipe on, wipe off, I feel.
It is
Karate Kid.
That is definitely wipe on, wipe off. Darn it. Okay. So you don't want, if you've got just property and you're doing deed of trust, which is what we've been talking about before, and you want to allocate income as Will described to his partner, then ultimately he would have to pay they would have to pay stamp duty, land tax collectively and capital gains tax, which is not a good thing. But in a partnership, you don't have to, because you could create a partnership agreement that says, well, they have no capital beneficiary interest of the property, but they can have a share of the profits. Now, you have to be very careful with all of this because there could be some stamp duty, land tax issues again. But if you word it correctly, you could have something called a deemed wage, which is what Louise was describing anyway. So actually, there are many benefits of using a partnership structure than it is a deed of trust, I would argue. And I'm right.
Horses for courses, team. Horses for courses.
So let's move on because there are some live questions and we've got to get through. It's almost like what my property expert panel.
6 minutes.
Yeah, we don't have long, so we better crack on. So you need to answer concisely.
I do. And this is the last recording, of course, before the 31st of October paper filing.
See, that's not concise.
Sorry.
Meaning, already we've done that one. So question on expenses on a tax return, please. And this is coming from Abdel Maths Tutoring 2021. Got to give you a name, shout out with a name like that. Say what you do. That's perfect. So from that side of things, an expense is just a cost in whatever you're doing, whether it's property. We've described that a lot already.
Or maths tutoring.
Or maths tutoring. I was going to say self-employment, but it could be a cost of you running your business. So mobile phone could be a cost. Traveling from one place to another, that could be a cost unless it's your normal place of work. But if you're a math tutor and you're doing private tutoring, you might have many clients. So therefore you could have many different places to go to. You can rack up mileage. You might have food whilst you're out. That too could be expensed. So there's a number of things that you need to think about of self-employment. And the way I would always do it is whatever you're buying, do ask that question of, can I expense this? One of my friends, funny enough, I'm not going to name him, did say, if I bought this very expensive watch, would that be allowable because I need to tell the time I'll get to my next meeting?
The answer is no.
Bit pushy there. But
also, I would say as well, just as a small giveaway, and it is only small, but every penny counts. Use of home. Go and Google Hmrc Use of Home. And it's a flat rate expense, meaning you don't need any receipts to prove it in terms of the expense you have. And it will allow you to claim a certain amount of money in effect as an expense for utilizing your home, your utilities when you're running your business. Because let's face it, when you're running a business, even if you have an office, I bet you do lots at home as well. So use of home, go check it out.
I'm just going to do a Google search on concise. Right, so Midlands has asked a question. If I'm getting to know areas where I'm considering buying property, not necessarily doing viewings, can I claim mileage and overnight accommodation, even if I don't subsequently buy the property there? Feel a no.
Unlikely, quite frankly. And although I'd be interested, not tonight because we haven't got time, I'd be interested in a debate between whether that is a legitimate expense in a limited company compared to a self-assessment.
It is, but then the question needs to go back to, if it's even a limited company, the company must be acting in accordance to its Articles of Association and memorandum, which means it's got to be commercially decisioned. So if you're seen to be kind of going to
having a jolly,
yeah, I was about to say having a great time in Blackpool. Sorry if you live in Blackpool, but
he hasn't been for a long time. We have an opportunity to change his view.
Great accountant up there, though. He's a nice guy.
Absolutely.
Steve. Big shout out to Steve from Fard Accountants. So where was I on that? So yeah, if you're going on a jolly, is it allowable? Probably not, because you should be acting in accordance to making a profit. And if you're just going on holiday and Hmrc see that, then you're not going to get
some of our clients have also in pre-COVID times, gosh, what were they? I talked about, well, I'm going on a skiing trip, but I'm actually going to host meetings with other joint venture partners or potential joint. No, because you could host those meetings over Zoom. You could host them in the UK. If those joint venture partners are also based in the same country as you, but you just happen to be going to, I don't know, some amazing ski resort. No, sorry.
Tiago Silva is a client of ours. He's just joining us at Optimize. I saw his name come up. And he said, hi, both. Thank you for your first call. Now enrolled with Optimize. So welcome to Optimize family. It's great to have you on board. You've asked the question, what are the benefits of buying an EV or pay a pension to reduce tax bill? Look, you're a client, right? So spend some quality time with our tax advisors, Tiago.
Book some time with us. We'd love to talk to you.
Don't just take these 2-3 minutes. Everyone listening, it's great that you're getting content in terms of where you might go. But I would always say go speak to your accountants after you've listened to us, really, ramble on. But Tiago, for you, please do book a call. Let's have that half an hour conversation. We are here for you, matey. So let's not.
And your question is a superb one. Lovely question.
Now there are some questions coming in. Jack Max asked the questions, but I'm sadly not going to be able to answer those questions because I've got my very first LinkedIn. Asma Patel, funny enough, has been kind of on LinkedIn asking the question. Hi, I came across a person who inherited a property from his parents. Now he is married. He's a high rate taxpayer, and he would like to transfer the rental income he's receiving from the property he inherited to his spouse. His name is not on the deed. How can he transfer the property? And again, the answer to that is deed of trust.
Deed of trust.
It's a
super thing. It's going to cost a few £100s to put it in place, and it will save thousands in tax, even probably in the first year. It's going to pay for itself in the first few months.
Yeah. Jack Mack, funny enough, might be able to get your question before 2 minutes. We are unmarried couple with a property in our own names. As solicitors said, it would be if a property is in a limited company, my partner's children can claim on his shares if we should pass away first. I think there is the kind of inheritance tax thing, moving assets from one person to another. I think that's a legal thing. To be honest, I'm probably going to stay away from that side.
You need to think about, so back to Simon's point about, do you have a will? Dying without a will is called dying intestate. And there are some very specific rules about how assets are passed through the family. So you could indeed find yourself where if there is no will, but the assumption was that the shares were going to come to you, actually the process that you'd have to follow through intestate rules would mean not one penny most likely would come to you at all. It would all go to their children and their offspring. So it's something you have to be very careful of and plan very carefully around. This is why I recommend to our clients every 18 months, check your wills, because I bet something has changed fundamentally in what you're doing and what you own, and it needs to be recorded correctly how you want it to.
Yeah, no, absolutely. It's astonishing how many people don't do that, and it's real basic. But I think that brings us to an end of the show, to be honest. I think there's been some great questions. I think we have to leave on what is the deadline for a tax return.
I'm so glad you asked. I haven't had the chance to tell anyone tonight. So if you are filing by paper, get those tax returns in by the 31st of October, which probably means you need to file and track that filing. You know, I'm afraid it's a little bit more expensive, but just give yourself that relief to know that you've tracked it and you can definitely confirm that it's been signed for and delivered at Hmrc by the deadline. So start filing processes, I would say, a good 5 working days before the 31st. If you want to file electronically, but you want to make sure, or you think your tax is going to be less than £3,000 and you want it taken out of your PAYE code next year, you don't want to pay it directly, get that filing done by the 31st of December. If you want to file your tax return on time and not pick up any of those horrible fines I just described to you, and you want to pay your tax bill and not pick up any of those horrible fines again, 31st of Jan 2022. And this is all to do with your tax return for 2021, 6th of April 2020, through to and including the 5th of April 2021.
Stunning. And if you are doing it by paper tax return, then make sure you get your abacus ready. And if you need to write down things on with your quill on that wax paper, then make sure you get your horse and cart to the local person. Get the ink pot from the octopus and then take it back and then do it paper. Come on, people. What do you mean paper-based? Get on electronics and get it done properly.
So some people have to file paper. They have no choice.
I'll take it back. Right. Good night, guys. And see you again soon.
Good night.